Welcome to Beating Sisyphus, a production of the Canizares Center for Emerging Markets in collaboration with the Cornell Emerging Markets Institute Club, live from Ithaca, New York. Beating Sisyphus brings together leaders across economics, technology, finance, policy, and entrepreneurship to explore how innovation emerges under pressure. Today, we're honored to welcome on the program Dr. Stephen Kamin, currently a senior fellow at the American Enterprise Institute. Stephen is a veteran of international economics, having spent over 3 decades at the Federal Reserve. As the former director of international finance, he was responsible for presenting global economic forecasts to the FOMC and advising the board on cross-border policy. He holds a PhD in economics from MIT and has served as a senior economist at the White House Council of Economic Advisor. Dr. Kamin, thank you very much for joining us today.
Thanks, Tom. It's great to join you, and thank you very much for inviting me on the show.
Of course, I'm looking forward to the discussion. So I'd like to begin with just, learning a little bit more about your background. How did you, get into such an incredible career in international finance and economics, and, end up working at such amazing institutions as the White House Council of Economic Advisors, the BIS, and the World Bank?
All right. Well, I'd like to start by noting that for people that are involved in international economics or international policy or diplomacy, a lot of Americans in that business actually tended to have lived overseas at some point, in their history, and I think that was very formative for me. My dad worked for a banana company, not United Fruit, but a lesser known one called Standard Fruit, and so I lived in Honduras and then in Ecuador, and that experience, I think, kind of sensitized me, to kind of like Latin American and emerging market policy issues. So then when I went to college, I studied both history and economics, and I wrote my thesis on the development of railways in Honduras. And then after getting my PhD, I went on to work at the Federal Reserve in Washington, where I was in the emerging markets section. And I started off by following Peru, Colombia, and Ecuador. And then I graduated to Argentina. I took a detour to Japan.
Okay.
And then went back and followed Mexico during their tequila crisis, which was very exciting.
Yeah.
And so I kind of like went on from there. So as I say, kind of like one's background and what you're interested in can be very formative in terms of your future career.
Absolutely. And it sounds like, you've been involved in studying a lot of those crises that have happened in Latin America and around the world. Could you explain a little bit, like, how has that formed your perspective on economic policy and economics in general?
Well, in fact, sometimes, my colleagues and I in the International Finance Division of the Federal Reserve, got to think of ourselves as really as like the crisis department. So when I was following Argentina, I had the pleasure for an economist, not to follow their hyperinflation in 1989 and 1990. Then, of course, there was the Mexican crisis. Then I had a little bit more of a global perspective during the 2008-09 global financial crisis. And then I retired in 2020, but right after the kind of like global coronavirus panic. So all of those crisis experiences kind of focus you on the fact that economies don't always proceed in the smooth, rational way that's depicted by a lot of models. Okay. Most of the economies I followed have spent much more time out of equilibrium than in equilibrium. But I still find some equilibrium concepts kind of useful as a framework.
Yeah. Yeah, absolutely. Well, that's a very fascinating perspective to be able to bring to the table in terms of, just understanding how, economies under crisis function. I think it also gives a really good perspective of, maybe thinking about in the US context, what is the worst case scenario that could happen and running those kind of models out and thinking about those things. Because oftentimes in the US context, We're not necessarily thinking about those. The 2008 financial crisis in some ways came out of nowhere. Certainly there were people that had thought about it and thought of that potential, but really a lot of economists, I think, were quite struck by that. So I think that perspective is super valuable.
Some economists like to focus on doing their research and writing their papers. I like to do some of that, but I also really enjoyed kind of my time at the Fed, kind of working as part of a team, dealing with, like current operational issues. In fact, there was a time in 2005 and 2006, which is part of what economists call the Great Moderation. But frankly, I was a little bored. There just wasn't enough happening in the global economy to keep me fully occupied and interested. I will say that since late 2007, I've never been bored.
Yes.
For better and for worse.
Yeah, no, it really has been quite a roller coaster ever since. There's always it's always something.
Yeah. I was interviewed by El País. I am originally from Spain.
Okay.
El País is kind of the New York Times of the Spanish-speaking world. And the lady asked me my forecast for 2026, the good, the bad, and the ugly. So I told her, I don't know. That's the short answer.
Yeah. Actually, when journalists ask me like, what's my outlook for the next year, I explained to them that if they were paying me, like for consulting, I would make something up. But since they're not paying me, I can be truthful and say I don't have a clue.
There you go.
So let's now turn to your 2022 paper. How do rising US interest rates affect emerging and developing economies? Why should we expect US interest rates to impact other countries' borrowing costs and rates?
Right. Well, there's a lot to unpack there. Let me start with why does it matter when the Fed tightens monetary policy and raises rates? And in terms of its impact on emerging market economies, there's a number of different channels. First and most obviously, when the Fed raises U.S. interest rates, they tend to raise interest rates all throughout the world. Just because the United States is such a large economy, because the dollar is so dominant in global financial markets, and especially for emerging markets, because a lot of emerging markets borrow a lot of their funds in dollars. So for starters, when U.S. interest rates and global interest rates go up, then emerging market economies have to pay more in debt service. And if some of these economies are vulnerable, if they have very high debt levels already, and very high debt service levels already, then it can be very costly to them to pay extra interest. So that's channel number one. Channel number two is that when the Fed raises rates, that tends to, raise the value of the dollar in foreign exchange markets relative to other currencies. So for an emerging market government that has borrowed in dollars and now, because of the higher interest rates, sees the dollar rise in value, that means that in local currency, it's now more expensive to repay their dollar debts. So that's the second important channel. And then finally, when the Fed raises interest rates, that tends to attract capital from the rest of the world into the United States. And again, that kind of like that reversal of capital flows that had been going to emerging markets can be very destructive. So for all those reasons, the Federal Reserve tends to, exert an overweight impact on economies throughout the world.
Fascinating. Yeah, so we've established that changes in U.S. monetary policy, changes in U.S. interest rates should be impacting emerging markets and international rates in some ways. And these real variables are clearly changing. Now, why would we think about the effect being differing depending on the type of the shock that the Fed is facing? And, what are those different shocks?
So let me back up a little bit. and talk about kind of like the poster boy for adverse Fed spillovers to emerging markets, which was the Volcker disinflation, in the very early 1980s. That followed a period in the 1970s when emerging markets had borrowed a great deal, benefiting basically from Middle Eastern oil revenues that had been funneled to U.S. and other advanced economy banks, and they were then relent to Latin America. At the same time as inflation in the United States and other economies, had become very high. So under Chairman Volcker, interest rates were raised to very high levels, like nearly 20%. This may be ancient history to you, Thomas, but I was actually working as a research assistant at the San Francisco Federal Reserve Bank during that period, so I got to see that firsthand. Those high interest rates in combination with the very high debt levels in these economies led to a so-called lost decade of poor growth in Latin America for the 1980s. And ever since then, observers have been very sensitized to the impact of U.S. monetary policy on emerging markets. Now, fast forward to the mid kind of like 2000s, 2004, 2005, 2006. At that point, the Fed again raised interest rates after having lowered them in response to the mild dot-com recession. And when I talked to folks, observers, before that, everybody said this is going to be very difficult for Latin America and other emerging market economies. And it turned out it was not that difficult. Latin America did fine. How come? Well, there are a number of reasons. For starters, the interest rate increase in 2003 to 2005 was not as great as during the Volcker period. But on top of that, we identified a couple other factors that we think might also have been extremely important. One of them was the fact that comparing 2005 to 1980, Latin America and other emerging market economies basically had become much less vulnerable. Okay, they had implemented a lot of economic reforms that made their economy more resilient in the face of external shocks. So that was one thing. But the other thing that we became very interested in, and this is in response to your question, Thomas, is that that it turns out that the nature of Fed spillovers, as we call them, to other countries, depended on the types of shocks to which the Fed was responding. In the early 1980s, Fed tightening was motivated by high inflation. And so the Fed needed to raise interest rates basically in order to throw the economy into recession in order to lower inflation. And that presented the emerging market economies with a double whammy. Not only the difficulties associated with high interest rates, but also the lost exports to the United States that were associated with the U.S. recession. So when the U.S. economy and the global economy go into recession, that is bad for emerging markets. In the 2005-2006, by comparison, that was actually a very good period for the global economy and for the U.S. economy. The reason that the Fed was tightening at that time was not so much because of rising inflation and worries about inflation, but because the economy itself was strengthening and the Fed decided that it could afford higher rates to basically keep the economy at an even keel. In that context, with commodity prices being very high, exports to the United States and elsewhere being very strong, the increase in interest rates was much less pernicious for emerging markets. So that's the reason why it matters why the Fed is tightening in terms of its impact on other economies throughout the world.
That's fascinating. So there's a clear distinction in terms of, what is the reason ultimately that the Fed is tightening. And in the paper, could you walk us through each of these factors? You talk about real shocks, inflation shocks, and then reaction function shocks.
Sure. So a real shock is in essence, in all these cases, we're talking about shocks that would raise interest rates, although you could also do the reverse, but it's easier to talk about if we think about increases. So in that paper, a real shock is one basically where the Fed is raising interest rates in response to a strong real economy. Okay, so high demand, high production, that ends up implying high imports from the rest of the world, including emerging markets. All that is motivating the Fed to raise interest rates. Just to back up, as you may recall, the Fed has a dual mandate. It needs to keep inflation in check, and it wants to promote maximum sustainable employment. So if the Fed sees the economy growing strongly, and that could ultimately threaten to raise inflation, then at least historically, it's tightened interest rates, even if the inflation factor hasn't been like a foremost worry for it. So in these real shocks, the Fed's raising interest rates in order to kind of like cool the economy a bit. But because the economy is running pretty strong, emerging markets are doing well, and they can handle the higher interest rates.
Is that our star is rising? There's like a productivity.
Well,
it could be a productivity shock of some sort. Is that the thought?
Well, not necessarily. It could be a demand shock, or
Okay.
it could be a supply shock.
I see. Okay.
Either of those, okay, which would tend ultimately to lead, which would ultimately require the Fed to raise interest rates, would be beneficial for emerging market economies.
Okay. Understood. Gotcha.
Yeah. So then we distinguish that from a couple other shocks, which would have more pernicious effects on emerging markets. You mentioned, so one of them is an inflation shock. That is to say, if the Fed was responding to worries about rising inflation, it would raise interest rates. And because the real economy situation hadn't changed, those higher interest rates would tend to push the economy down into recession, and that would end up reducing U.S. imports from emerging markets, and that would be difficult for them.
Okay, and just on that one, sorry.
Sure.
You're saying when we're thinking about it from like a supply demand perspective, when I think about demand shock to inflation, is this an avenue that works for, or is it the demand shock purely going to be through one of those real shocks like you mentioned? So like basically when I push, an output goes above potential, you get a demand, cause the demand push kind of inflation versus the supply kind of, or demand pull versus supply push kind of inflation. How would we think about distinguishing those?
Right. Well, that's a good point. So we actually, in our research, we kind of dabbled in thinking about looking at supply versus demand shocks. But in the end, we ended up using a different dichotomy, which is responding to improvements in the real economy, wherever they might come from, versus responding to increases in worries about inflation, wherever they might come from. Now, just as a minor aside, if you thought about the U.S. economy experiencing a strong supply shock, which is to say, an increase, for example, an increase in oil prices, okay, that led to higher inflation. The Fed might not respond to that. Okay,
Look through it.
Yeah, exactly. They might look through it. So that might end up not even appearing as an increase in interest rates in our database.
Okay.
So as it turns out, the types of shocks that basically were, number one, we're thinking about, and number two, which would enter into our database of increases in interest rates, were more likely to be demand shocks. Okay. Gotcha. So then if you ask, well, what's the difference between an increase in interest rates reflecting a real shock and what's the increase in interest rates reflecting an inflation shock? It might be more the question of severity. Okay. So like in a real shock, right, you have increased demand, it pushes the economy up. but for any number of reasons, the impact on inflation is not likely to be that great. The Fed's mainly just responding to the greater economic activity.
I see.
Conversely, in the inflation shock we're talking about, maybe the economy is already pretty inflated. Okay. And maybe it just takes a little bit more extra demand to then push the economy into an inflationary situation.
Okay.
Let me just add that in emerging markets, we may see a little bit of a different situation because inflation is often endemic, related also to the fact that the currencies are quite weak. Look at Brazil. I mean, this year the currency has revalued, which is good news, from 6.1 to 5.4. But at the same time, interest rates are kept quite high because the fear of major inflation.
Right.
So how do you see that? And if you could also talk a little bit about the yuan, where there is no inflation in China, the interest rates are low, and the currency remains, with respect to the dollar, quite undervalued. And we complain about that to China. So how do you see that also? I wanted at some point, if you can see your views about the yuan entering the international trade, entering international loans to countries. How do you see, will this disturb the current situation also for the US?
Well, there's a lot there in your question. For starters, let me just say that the approach of my co-authors and I toward categorizing the different shocks to which the Fed is responding is more specific to the U.S. and Federal Reserve economic situation necessarily than other emerging markets. So if I wanted to repeat the exercise for Brazil, okay, I guess I'd have to think longer and harder than I have, which is not at all, in order to decide whether my framework was most appropriate to Brazil. So I'm gonna put that on the food for thought shelf. On the yuan, what seems to be happening is that the authorities have probably prevented the yuan from strengthening, as it should have in recent years, when prices in China remain very stable, even as they rose very precipitously around the world. So if you look at the Chinese currency, it's actually kind of interesting. In nominal terms, all right, the yuan against the dollar and other advanced economy currencies has been more or less stable or flat since 2022. But in real terms, it's actually depreciated substantially because prices around the world have risen so much. So that, along with a pronounced pattern of industrial subsidies, has helped Chinese exports grow very rapidly in recent years. And that's eliciting a lot of political pushback because, economies around the world fear that their manufacturing sectors are being hollowed out by China. And so the US has responded with increased tariffs, and that just has the effect of pushing Chinese exports to other economies. So it's a very difficult situation, and one that, that policymakers around the world are busy ineffectually worrying about.
Absolutely. So it seems like they're, the U.S. transmission and the Chinese context might be slightly different since there's a bit more currency management on the part of the government.
Yeah.
And that's an avenue that you highlight in the paper, actually, through, a currency changes in those emerging market currencies as a transmission point. And I want to get back a little bit to the paper on that front.
Right.
Do you think, by China managing their currency in such an aggressive fashion, there might be a little bit different in terms of the effects of that transmission?
Yeah. And on top of that, China manages its capital account much more closely with many more constraints than a lot of the major emerging market economies. that we've been following.
Mm.
So, so they're less prone to what are known in the business as sudden stops of capital, just because they limited the inflow, they limit the outflow. So I guess the way I think about it is their financial system is probably less sensitive to U.S. monetary policy than the financial systems of many other emerging market economies.
Mm.
So,
I
so
see.
as we discussed, I tend to view China as, I think the term is sui generis, but whatever that means. But the point is that I tend to put it in a different basket than most of the more traditional emerging markets.
Gotcha. Okay. So we've seen on the US side, it really matters what is the shock that the Fed is responding to.
Right.
Is it a real shock, inflation shock? There's also the reaction function shocks, which basically the Fed is becoming more hawkish overall. But it also
Yeah.
matters about the emerging market economy itself. And in the paper, I think it might be I think it's slightly further down in the paper.
Yeah.
You talk about how between different emerging market economies, there's different impacts from these different shocks. Could you dive into that a little bit more?
Sure. Basically, if if an emerging market economy has very high debt levels, if it has very high inflation rates, if it has large fiscal deficits, if it has a poorly managed and supervised banking system, all of these factors are going to kind of like both reduce the resiliency of an economy with respect to shocks, and it's also going to reduce the confidence that foreign investors have in that economy. And so the effect of all that is that when the Fed raises interest rates, okay, that economy is going to find it more difficult to find the resources to pay higher interest rates and to pay the higher domestic currency value of existing dollar debt. It's also it's also going to be the case that seeing that foreign investors are going to be much more likely to move, to basically flee the
Mm.
emerging market economy than in the case of an economy with much better fundamentals. So those things matter a lot. There's a little bit of a controversy in the literature as to how important the fundamentals are in terms of the response of the economy to U.S. shocks. But I'm pretty confident that it matters a lot.
Absolutely. So there's not only the specific impacts when the Fed is reacting to different things domestically, but also we have, again, like you mentioned, it really matters how resilient are these individual emerging markets. And in a 2025 paper titled Why Emerging Markets Weathered the Federal Reserve Tightening So Well, again, you highlight that despite the hawkish stance of the Fed, a lot of emerging market economies really didn't see spreads rise and they mostly stayed stable. Would you say that's, like you highlighted in the 2005, 2006 era, it's just because these emerging market economies overall have gotten a lot more resilient?
Well, I think that's part of it. That's
Mm.
definitely part of it. But in my paper, I highlight two other factors.
Mm.
The first is that during this period of the last few years when the Fed has raised interest rates, United States corporate credit markets actually remained quite buoyant, quite accommodative, and that's reflected in very low credit spreads for U.S. corporate bonds, as well as, rising stock prices, et cetera. So it turns out that emerging market credit spreads, which is the difference between what they pay in interest and a safe U.S. Treasury bond, those credit spreads are incredibly well correlated with U.S. corporate credit spreads. So when U.S. corporate credit spreads stayed so low, that also translated into basically lower emerging market credit spreads, which is an indication that emerging markets actually had not come under much financial pressure.
Mm.
So that's one of the factors that my recent paper highlights. The other factor is just that when we did an exhaustive analysis of the impact of U.S. monetary tightening the inflation and reaction shocks we've been talking about, when we looked at the impact of that on emerging market economies and looking at their credit spreads, it turns out, yes, that they matter. Yes, a monetary shock, as we called it, would raise credit spreads in emerging markets. But if you then looked and asked, okay, well, how important has that been in the evolution of emerging markets, quantitatively? The answer is not that important. Most of the variations in the financial situation of emerging markets has actually come from big exogenous shocks like the coronavirus crisis and like the 2008-09 global financial crisis. The actual amount of emerging market turbulence directly attributable to the Fed turned out to be quite minor.
Okay. So is this to say, in some senses, how would you interpret that the fact that variation is really not being explained largely by Federal Reserve action? Is it that the U.S. policy is becoming less important? Again, you highlighted that idea that it was moving along with those corporate credit spreads, and maybe in some ways investors see those as I don't know, substitutes or comparable, like emerging market versus a domestic firm that's pretty risky. What's kind of the thought there as to why the variation, just from the data you saw, is seeing a little bit less importance of U.S. Monetary policy?
If I may, going back to the China factor, because China has become such a huge economy, having so much influence in the rest of the world, establishes some kind of disturbance for what has been the norm for so long. And if we look also, we did an exercise looking at the last 25 years, emerging markets have done very well. So could be legacy, and could be, of course, there is one more in the block, that is China. China continues to lend, continues to invest in other emerging markets. So how do you see that with a very stable currency, manipulated but stable?
Right. Well, first, let me address Thomas's question, and then I'll get back to yours, Lourdes. So on your question, Thomas, I think that what happened is that a lot of our thoughts about the spillovers of Fed policy to emerging markets kind of was formed, in the 1980s and 1990s, when these economies were much more vulnerable and they had much poorer policies. I think that since then, with the advent of inflation targeting, with more floating exchange rates, better bank supervision, in general, though not always, lower fiscal deficits, they've just become less vulnerable to shocks such as higher U.S. interest rates. And then to Lourdes's point, certainly the advent of China on the world economic scene has been very important. It's produced this huge source of demand, particularly for the commodities produced by Latin America and other emerging market economies. So if you thought about the rationale between my division between real shocks and inflation shocks, where a lot of that had to do with how the U.S. economy was doing, and how and the U.S. demand for imports from Latin America. Well, now that's got to be less important, with China being the number one trading partner of most South American economies.
Absolutely. Yeah, that makes a ton of sense.
Yeah, as you know, what they call the original sin of emerging markets is the fact that they all have, again, with the exception of China, a very weak currency, and you mentioned that a number of times. So is it happening that the dollar dominance, mainly after the Liberation Day, this has changed? So how do you see that impacting emerging markets? And also the abysmal fiscal responsibility that may be challenging the dollar dominance?
Right. Well, there's a lot there to unpack, too. Let me start by talking about why the dollar's been so dominant, and then why people are worried it may not continue to be so dominant. Why has it been so dominant? People, myself included, list many factors. Probably the number one factor is the safety and liquidity of U.S. Treasury bonds. which in turn depend on having a fiscal balance that's not out of control. Then on top of that, there's the strength of the U.S. economy and its dynamism. It grows quickly. Okay, our rule of law, in particular, which protects foreign investors. The prudence of American macroeconomic and economic policy, especially including the independence of the Federal Reserve, and our close network of alliances with our trading partners in other economies. So those are all the factors that in combination have supported the dominance of the dollar in global markets. So enter the Trump administration, and every single one of those factors is now at more risk. Out of control fiscal deficits, threaten that safety and liquidity of U.S. Treasury bonds. Similarly, giant tariff barriers both bum out our allies, and they also reduce the dynamism of the U.S. economy. Assaults on the independence of the Federal Reserve, obviously raise investor concerns about the safety of their investments. And as I've already mentioned, the many things the administration is doing, to betray, contradict, or take issue with our allies, kind of like weakens the international ties that also support the dollar. So for all those factors, people were worrying about prospects for dollar dominance going into the Trump administration. And then Liberation Day on April 2nd, when Trump announced, huge numbers of so-called reciprocal tariffs with many regions around the world, including some that actually had no people in them, also represented a huge shock to the to investors around the world. Not only did the stock market plunge and the VIX index, which is a measure of volatility and uncertainty in equity markets, soar, but then uncharacteristically, instead of rising in response to higher VIX, which is what the dollar usually does because it is a so-called flight to safety currency, instead the dollar plunged. Mm-hmm. And that kind of signaled to investors that maybe the dollar was no longer a flight to safety currency. Maybe it was more of a risky emerging market type currency. So since April 2, markets have calmed down and in fact become rather exuberant again. And so I wanted to know, what's happened, to the dollar? What's happened to its safe haven approach? So I estimated a simple model just relating the value of the dollar against several other advanced economy currencies on the difference between United States and foreign interest rates, which is a measure of the relative attractiveness and rate of return of dollar assets, as well as that VIX measure of financial volatility. And the outcome of that was a couple of things. First of all, we looked at the model's ability to predict the level of the dollar compared to the actual dollar. And so it turns out that after Liberation Day, the actual level of the dollar plunged well below the value predicted by the model, suggesting that indeed Liberation Day had triggered some depressive factors in the dollar that were not being captured by the model and might be this kind of like response, an adverse response to rising volatility. Mm. Secondly, we looked specifically at the response of the dollar to the VIX, using a kind of like a moving window of estimates. And it turned out that, again, after Liberation Day, the sensitivity of the dollar to the VIX switched from positive, its usual flight to safety value, to negative, very significantly negative, again suggesting that Liberation Day had triggered a switch in the behavior of the dollar from flight to safety to risky risk on currency. Mm. So those Those findings seem to confirm the view of market participants that indeed the market might be rejecting the dominance of the dollar in light of recent Trump actions. But in the months since then, the predicted level of the dollar has converged with the actual value of the dollar, and the sensitivity of the dollar to the VIX has moved back into more normal, positive, or bouncing around zero territory. The point of both of these facts being that it kind of looks like whatever happened right after Liberation Day to shock global investors, they have for now gotten over it.
Mm.
So I don't view this as necessarily indicating that we're all back to normal and it's all good, but it does suggest the financial markets are resilient.
Yeah.
And it will take some combination of further shocks or further deterioration in the fundamentals of U.S. economic policy before you get a more concerted move away from dollar dominance.
See, that's fascinating. So initially, there's kind of almost you see almost a structural break between that relationship that once existed, but now it seems to have returned. Thankfully, markets seem to have calmed down, potentially as a result of policy becoming a little bit more clear. Obviously, there's still concerns on that front, but for the most part, I would say policy has become a little bit more available and clear to investors so they can understand. One quick methodological point: when you're using the VIX index, is that a measure of volatility specifically of the S&P 500, or is it a global one? Because what my mind immediately thinks about is basically on Liberation Day and following right after, international equities actually outperformed a bit. And I don't know if they were necessarily less volatile, but that might be maybe a subtle difference there. I don't know if you would happen to know that.
Yeah. Well, the VIX is indeed a measure just of volatility in United States equities.
Okay, understood.
It tends to be used, perhaps wrongly, as a measure of investor uncertainty and volatility around the world. It's it's a bit of a stretch, but economists like to look under the street lamp, and that's the measure that's under the street lamp.
Of course. No, it's a great measure too because it has very high frequency, very well, a lot of activity and trading volume. So I think that makes a lot of sense to use.
You should think of it as a proxy for volatility and uncertainty, not as the final word on it.
Okay, absolutely. Yeah, that makes a lot of sense. So in our final minutes here, I'd just like to ask you, this is a question that we have for all the guests that we have on the program. What is one emerging market economy that you'd like to highlight and why? Perhaps one that you've worked on during a crisis and you've subsequently seen growth and recovery in.
Well, I'd like to highlight China, which we've already talked about, as the case of an emerging market economy that started very poor and pulled itself out of poverty for sure, and is heading toward even greater levels of development. But I cannot avoid talking about Argentina. So Argentina is my choice. First of all, it is the prototypical emerging market economy in terms of its volatility. And because fascinating things are happening there right now. All right. So, right now under President Milei, he's involved in a stabilization program. That is not the first stabilization program that Argentina has undertaken. And since I have been following Argentina since the late 1980s, I think I'm in a good position to judge its prospects. I would say right now, Milei has achieved greater success than most of its predecessors until you go back to Domingo Cavallo in the 1990s with the so-called convertibility plan for a currency board. And he is attacking the fiscal deficit again with greater aggressiveness than has been tried until all the way back then. So those prospects are good. And then add to that the amazing dimension of the Trump administration offering the unprecedented $20 billion swap line for a country with no collateral to offer, and not a very and let's put it and an IMF program that lacks conviction, and it's an extraordinary set of circumstances. Now, I have been advocating that that Argentina take advantage of both its reduced fiscal deficit, its falling inflation, and its $20 billion from the United States to dollarize, which is to say to buy out the amount of existing pesos and just convert to dollars. Because I've seen this movie before and it's never ended well before. And my experience is that when an Argentine stabilization program starts working, people get complacent. And when they get complacent, the fiscal deficit rises again. But I am in the minority, okay? Most conventional economists understand that the Milei administration is walking a very narrow path that is fraught with peril, but they kind of think it's the only path open to it. And they actually advocating floating rather than the current strategy, which is to basically continue to use dollars to keep the peso from depreciating too quickly. I kind of agree that if they're not going to dollarize, they should float the currency. But I kind of like the dollarization option more.
Yeah, yeah. I think it's a very good point to be made, and it certainly, as we've seen in countries like Ecuador, has helped really eliminate that inflation completely, take it out of the hands of the government, which tends, in these countries to be quite irresponsible with their fiscal policy. And so I think a very, very fair point to be made there. Well, that's about all the time that we have left for the show. And I really want to thank you so much, Steve, for coming on the program. It was truly a huge honor to have you with us. I really appreciate it.
Sure. Well, thank you very much. It's been great to be here, and I'm delighted to be able to share my views, bizarre as they are, with your audience.